and from a secular growth perspective, that there's going to be huge disruption in rejuvenating the energy sectors and the manufacturing sector in the US. And so the Seven Fund is focused on that. There will be a lot of investment opportunities across real estate, debt, private equity in these sectors. We think there's a venture slice, and we think the demand for energy can't be satiated. It's generally grown 50 basis points a year. Last year it grew 4%, and it's eroding the cushion. We have to find ways to be more efficient with the energy, and we think applying AI there can be really helpful. Also, battery technology, small nuclear technology materials. And on the manufacturing side, we're not going to replicate the supply chain that was overseas. We're going to build a new supply chain here using new technologies. So technologies like 3D printing that have been a bit of a damp squid to date, I think will come into their fore. Yeah. A lot of things around logistics, but also you then combine 3D printing with AI solutions to the physical problem you're trying to solve, and you end up with innovative designs that would not have necessarily been built by a human with a slide rule, but you know what I mean. Yeah. And with the limitations. You have something that looks quirky that solves the problem and addresses it in ways that you wouldn't have thought of before. And the iterative process, as you talk about, with 3D printing combined with AI design work, can lead to whole new innovations.
Hello and welcome to Fireside with the VC. My name is Andrew Romans, and we are today with my old friend John Frankel, who is the founder and partner at ffVC Capital, an icon of what I call OG emerging managers in New York City. John can tell us when you can stop calling yourself an emerging manager because it's coming up on more than 2 decades. He was a partner at Goldman Sachs for years and years, and so he knows, and Arthur Andersen even taught him what numbers are on a balance sheet and all that. So qualified to be investing and hopefully knows how to raise money. So John, welcome. Great to see you again.
Well, thank you for the introduction, though. I would have preferred if you said your young friend.
Oh, right. Oh, my young friend. Oh, yeah. We were both just born yesterday. We just met, and we hit it off immediately on talking about all things AI, venture capital, and the math versus fund size of the venture industry, which is what we're going to talk about today. So why don't we dig into, John, you've got, if nothing else, that perspective of reading what are the revenues growing of a startup and where were their expenses going? And, what percentage used to be headcount before AI started? So I kind of want to talk about what's different with AI native startups compared to your just endless experience or your brand new experience as a young lad getting into venture now.
Well, so I've been through a few cycles. When I joined Goldman, we were still using mainframe terminals. I was there for the transition to client server, internet, mobile, the beginnings of AI 10, 15 years ago, embedding it into product. I was in a board meeting about a year ago, and I said, this is either an asinine VC question or quite profound. And I said, what is it that you're doing to work out how to use AI in your own business to run it more efficiently? And I just struck a nerve because, oh my God, I've been thinking about this, losing sleep. And it became clear as I spoke to more and more of our CEOs that every one of them was trying to solve this problem. They knew there were ways to run their business more efficiently across every department, and they didn't really know how to do it. And what it reminded me of when Lotus 123, the precursor to Excel, came out. It was a revolution because you suddenly put powerful computing capabilities, spreadsheets with macros, in the hands of the end user in the company. And I remember, Goldman, one of the jobs I did was one of the high-profile jobs in controllers at the time. and I reduced a day's worth of work, the option P&L, which was very pencil and paper driven, to 10 minutes work on a spreadsheet. And I went to my boss and I said, okay, now what? Because this whole job, which was the sexiest job in controllers, is now 10 minutes.
And it also doesn't make a mistake. Excel, well, I mean, but Excel, theoretically, you're like equals the cell to my left times 1.1 and drag it out. It's like,
it's deterministic programming. AI is probabilistic, and that's a different issue. But the reason why I bring up that example is because today, using these agentic workflows, we call them AI point solutions, because there are different point solutions in different parts of the business.
And what's your acronym
AI
for that?
Point Solutions, or AIPS.
Right. Okay.
And what we found was different companies had found different AIPS, and we as a VC firm, we said, how do we add value? We networked everyone together. We brought experts in. We do webinars. We have shared materials of solutions for different things. But what became clear, and the reason why it was like that transition to client server, this is not mandated by the CEO. You will do it this way. When I was at Goldman, no one who I reported to all the way up would have said, oh, solve this with a spreadsheet. It was up to the person in the field doing the work saying, oh, I could actually do this more efficiently. In the same way, whether you're in legal, you're in marketing, you're in engineering, you're in compliance, you're in recruiting, you see the problems, you know your own workflows, and if you understand the tools well enough, you can compress work down substantially. So one early example was the need to move from one version of Java to another. And the CTO sat down with his team of 20 people and said, look, it's going to take us about a month. And as he's doing it on the whiteboard, what they need to do, one of the guys puts his hand up and said, I just did it. It is fascinating how they've been able to change workflows. So we have, I'll give you an example. We have a company of 400 people. And 400 is the
one of your portfolio companies.
No. We have one of our portfolio companies has 400 employees.
Right.
And that's a lean number for them because they used to be at 800. And then, they want to get to profitability and back to growth. And so they trimmed to 400. They've been stuck at 400 despite growing 50% this year. And they plan to stay at 400 going forward. And they're using AIPS, AI point solutions, within their business to be more efficient. And they see themselves as transitioning to an AI first company. Now, they've had AI in the product from the beginning. So they were well positioned to be introspective about the tools they use. And then when we look at them versus a competitor of theirs who has 10,000 employees, I think they'll take a decade to do it. Maybe they have Salesforce, and Salesforce will say, oh, use Einstein, our AI tool, and they'll tick the box, but they won't actually be doing the same thing.
Right.
So I think the smaller organizations have advantage. And historically, if you were a 400-person organization growing at 40 to 50%, you would have to add 25 to 30% headcount a year. You'd get some operating leverage, but it's so disruptive. You're diluting your culture 25% every year.
So slow down and understand what you're saying. So what you're saying is that if you've got 400 people a year and you're growing at 40% year-on-year revenue, in yesteryear, we would have noticed headcount growing somewhat corresponding to the revenue growth. And with each, provision someone into the organization results in diluting culture. It's like if you drop a hot rock into a beaker of water, it'll change the temperature of the water and change the temperature of the rock, right?
Right, but it's not just that. So you have to have a hiring mechanism. You've got to bring 100 people on board. You have to train them and bring them on speed. But it's not just that. It's if you have 2 people in a group, there's 1 line of communication. You have 3 people, there's 3 lines. You have 4 people, it's 6. You have 5, it's 10. So as departments get bigger, decision making slows down because you need to bring everyone along. and things get fragmented. If you can maintain a smaller team longer, you're a much nimbler organization in decision making, in product enhancement, and the like. And so, what we're seeing is the smaller the organization, the easier it is for them to adopt it. The CEO's responsibility is to set a culture, to not just hire for skills, but they have to hire for this quality that we call agency, which is I want to come in and look at my job and then on the fly reorganize it with all the new tool sets. And unlike prior cycles, so the internet cycle, once you got your head around the internet, that knowledge was good for 4 years. Today, if you knew everything in AI and all the tools today, that knowledge is good for about 4 days. And so if we stopped inventing anything new in AI, it would take a decade or so to flow through. But we're continuing to develop. And if we really develop AI at the pace that some of the leaders in the industry think we can, and there's going to be some hype in there, but it may be some parts will be overhyped, some parts will be underhyped. But if we continue to develop, it makes it very difficult to know where the value add is going forward. And as VCs, there'll be a lot of misallocation of capital because people will chase technologies and not business solutions. But it's fascinating. It will reverberate across the whole economy.
Yeah.
Just as software is eating the world, AI is literally eating software, but it's also eating services.
Yep. It's interesting. One of my LPs oversaw the technical development of Chrome at Google. So he made a lot of money there. And he said that, and I would have him having dinner with like Raul, the CEO of Superhuman. And he was saying, I really never wanted to see more than 40 engineers working for me at a time. Like if the team got bigger than 40 at Google, I felt like we were no longer Green Berets just slaying it. And now that Superhuman was getting so much funding, he and Raul were kind of like agreeing on how to keep the team small enough to not get slowed down, by all of this. What are you seeing in when you would look historically in like pre-AI on the expenses of a high growth startup, the kind that FF would be funding? Hopefully, we were funding them together. What percentage of the expenses were going to headcount?
Generally, if revenues were growing 40%, you would expect headcount to grow 25%.
Okay, so headcount would be growing 25%.
And now, I'm not talking in the first year or two because it's all off small bases. But if you're at 10 million or above, that's generally the rule.
Okay. And even in companies that are like 1 to 10 and above, what percentage of monthly operating expenses were going to headcount and what was going to like AWS?
So we actually track all those metrics, and the amount that goes to AWS or Google and Facebook for marketing, etc. It's an obscene amount. When you add it up across your whole portfolio, it's an obscene amount for sure. I think headcount, and it depends on the business model and the capital intensity of a business model, but you can think headcount, ideally you want it to be 80%.
Right.
Now, in marketing heavy companies, it's a little different if you're particularly on consumer. We don't do a lot of consumer nowadays, but we used to back in the day.
Yeah. I mean, because what I've noticed in the last 2 years is that what was 80% kind of headcount, and it might be less, but it sure feels like that. And then something like 15-20% AWS type expenses switches to we're not adding as much headcount. Headcount as a percentage is coming down. Sometimes, and you see like compute potentially hit 50. So these are like the AI native companies. So it's just a different looking set of expenses.
It is, but also understand compute costs today is not normalized. We're like in the early days of Uber when it was cheap because it was all VC subsidized.
Right.
In the same way, there's enormous subsidization going on in order for people to build businesses around it. And we don't know what the normalized compute cost will be going forward. But in the interim, there's an arbitrage. You've got relatively cheap compute. Now, AWS is AWS and mature, but when you're using solutions that use compute, that's where the subsidy comes in. So if you use a note taker, the one that's very fashionable right now is Granola. The free account gets you 95% of the way there. So they have enormous amounts of free accounts. Thank you, whoever is funding Granola.
Yeah. Well, so takeaways here are we're seeing smaller team challenging an incumbent. The smaller team can kind of bottoms up and tops down put AIPS, AI point solutions across their operations. And
Yes.
one person's doing the job of many, many people. And it's a challenge for an incumbent company with, a bloated 10,000 to, ward off the attack of this new challenger.
So there's two small elements there that are worth calling out. Firstly, if you have a team of 40 engineers and each one can be 10 times more productive, not today, but over time, do you go to a team of 4 engineers or do you do a lot more work? And I think it's the latter, not the former. I don't think we're capped on the innovation, but a lot of people think a lot of people get fired in this process. And I don't think that's necessarily the case, but there is this digestion as we're actually bringing productivity into organizations that has to ripple across.
Yeah, I think
the second thing.
Yeah, I would say most of these companies have ideas, right? They have like a roadmap. So if Uber felt like we can do taxi share ride with this number of engineers, rather than fire an excellent person that they provisioned in, that they've got culturally super pumped and all that, they're going to say, let's go after food delivery and medical, right? I mean, unless you're running out of ideas.
Right.
I think that
No. Yeah, companies generally were constrained, and so there's more ideas and more roadmap and moving the roadmap faster, which makes you more competitive versus larger organizations. And then the second one is in some sectors, some large organizations are very status quo. They hire a new person out of college and they're like, I'm really great, and they're raring to go, and they come in and they're working all the hours, they're working hard. And after about a month, their boss says, chill a little, pace yourself. It's a marathon, it's not a sprint. And the person's still doing this because they really want to get on with their career. And about 3 months in, the manager goes like, calm down. You're embarrassing everyone around you, because their boss and everyone around them wants to clock in at 9 and clock out at 5, and they don't want to be hyper productive. And yet, these kinds of tools, AIPS, allow individuals to be hyper productive in organizations. So there will be organizations that will culturally accept it. And that's where startups and CEOs and the like can really work hard to do it. But a lot of established companies will culturally reject it because it will force change on people who don't enjoy change, people who don't have agency. So it's going to be fascinating. It's going to take time to work its way through the economy. It will be disruptive in various ways, but net, we're going to end up with better products. It's deflationary, like a lot of tech, and that's going to offset, other inflationary forces in the economy.
So let's talk about, with the time we've got left, let's talk about what that means for venture capital and have a conversation about fund size and the math from going through different stages and what it means now. And as this really rolls out, if like the internet took 20 years, we're kind of in year 2 of kind of this new cycle. And then I want to end up getting an update on what FF Venture Capital is doing, what the next funds look like, and what the existing funds are, and the strategy within FF. What's if a startup can do more with 40 engineers than with 400 engineers? What is your view on stage of investing and even fund size and stage? Even going back to maybe how that fits not only with where we are in this AI moment in history, but where we are in the economic cycle. You've certainly seen a few cycles from Goldman to FF and what that meant for how well the pre-IPO growth investor was doing and how the kind of pre-revenue seed investor and then everything in between.
So I've seen a few cycles, and the first thing to understand is where you are in a given cycle. So in the public markets, the stock market's doing great, particularly for the largest, 7 to 10 companies in the S&P. The rest are doing fine, but they're not doing great yet. As they deploy AIPS in their businesses, they should be able to expand margins, etc. So this will take time to work its way through. But I could believe we're at the beginning of a long boom. And I think as some of the hype of the largest companies starts to dial down, we'll get some increased profitability for the rest. And so I think the index overall is a nice, interesting way to play that. That being said, venture marched to different beats. So we had enormous pools of liquidity coming in 2018, 19, 20, peaked in 21, and that has really drained off. One talks as venture as if it's homogeneous, but it's really heterogeneous. Most of that capital came in was late stage, and I'll argue $1 billion plus funds aren't really taking venture capital risk. They're just private equity for high growth companies. What we tend to do, we tend to invest, can be pre-revenue, can be early revenue, when a team of 4 or 5 people, and we tend to invest that valuation generally below 10 million.
Even today?
We invest up to like a 50 million and stuff. So we're at an early alpha stage. As funds get bigger, they really can't cut checks that are less than, 3 to 5% of their capital, because it doesn't move the numbers. And so the bigger the fund, the later stage they have to be, and the biggest funds are very late stage. That late stage I see as more momentum driven. It worked great until 21. Last 5 years it hasn't worked. I think the next 5 years it will. So this late stage momentum I think works for about half a cycle. The early stage, very value driven, being very sensitive price you get in, I think works throughout the cycle as long as you're disciplined. We didn't do any of $100 million pre's, the $50 million seed rounds, kind of stuff, because we didn't think the economics work. I mean, look, if we're really good, we're going to return you 3 times your commitment. If I give up a turn on that first check and I go in at 20 million versus 10 million, it's going to be $1 billion outcome anyway, right? I give up a lot. I'll give you an example. We have a company. We put 800,000 in their seed round, about a 10 million valuation.
And what stage were they at, John, when you put in, at a 10 million pre?
Very early stage and a slightly different business model.
Okay, so they've since pivoted, which is to be expected. But you're left with the same team at least, yeah.
Yeah, very small team. Today, they're running, 400 million revenue run rate kind of business, profitable, rule of 40 company. They're doing great. So 800,000 was marked Q3 last year to 25 million. Q4 is marked to 27.5 million. And literally every quarter, we're just having to mark it up because of the revenue growth and the multiples. Multiples compressed from 21 down to now. And I think over the next few years, they're going to expand somewhat back up. I don't think we'll get back to 21 multiples. But, the strange thing is this is in a relatively small fund, a $40 million fund. And when it exits, it can, this one investment can return the fund 3 times.
How many?
None of our metrics capture it. It's difficult to be up 100 times, difficult to be up 30 times, 50 times, 100 times or more in a later stage fund because the exit value has to be even higher.
That's right.
The advantage of the early stage funds, the ones you're going after with your fund approach, is you can have real high multiple returns, and you hit a couple of them, and it really moves the economics for the whole fund.
So with that 800K example as a check out of a 440 million fund, that gets close to returning the whole fund, or it could potentially return the whole fund, or 3x.
I mean, to be clear, if it does what we think it'll do, that one check will return the fund 3 times.
Right. It certainly makes up for some early stage losses
that we think will return the fund 2 times. Hasn't yet, but if it does what we think it'll do. And then you've got, a whole bunch of other investments that are doing whatever they're doing. It's a power curve distribution. And so you get these kinds of economics out of these very early stage funds. In fact, if you think about it, early stage funds themselves are a basket of alpha. And if the fund is reasonably diversified, or if you have a funds of early stage funds, you really have a basket of diversified alpha, which is a great addition to any portfolio because it's not correlated with the price of oil, the economy, interest rates, war in Ukraine or whatever.
Yeah. Well, I owe you a drink when I see you next week in New York for saying that, John. But
it's true.
We wouldn't be doing it if we didn't believe it. I mean, looking at statistics of what percentage of companies exit at above $1 billion, how many companies has Google acquired for over $1 billion, and if your fund is more than $1 billion, and you're investing in these late stage, what percentage outlier do you need to be in to begin to deliver any kind of alpha? And how long is that taking?
And because you're late stage, you're picking out of a smaller barrel, right? Because fewer companies get to the stage you're investing, and they're more known quantities. So a lot of people will buy logos. Like if I'm running a late stage fund, why wouldn't I go and buy, some SpaceX so I can put a logo on and then people don't know whether I bought it in the seed round or the series whatever round.
Yeah. Does Elon Musk know the names of your children?
I get that sort of halo effect.
Yeah. My joke is, does Elon Musk know the names of your children? I doubt it. Are you even on how many SPVs did you go through to put that logo on your website?
Exactly. From our perspective, we've got 17 years of data. The firm was founded in 2008. Over half of our pre-seeded funded companies go on to raise a seed fund, an A, and a B.
Okay, it's a huge graduation rate. That's what we call that.
It's 5 times what Preqin says is the average. Our stated objective when we invest in a company is, can it get to 100 million revenue run rate? And 11% of our companies have got there. And I don't know what the industry average is, but anecdotally, it seems to be 1% or less. And if it's 100 million of revenue, depending on the multiple, it's $1 billion outcome. Could be less, could be more. It depends on the growth rate, the margins, and all the other, and what the market is when we come to exit.
Well, John, let's use that as a segue to shift gears into FF now, and we can wrap up. So, maybe give us the quick snapshot on FF until now, and what are you working on with the next fund that we hope to be part of as well from our fund of funds?
So we have an office in New York. We're in the Empire State Building. We've raised 6 funds in the US. About 5-6 years ago, we opened an office in Warsaw, and we have 2 funds in Europe. We're raising a 3rd fund in Europe, and we're raising a 7th fund in the US. And our US fund, we're generally generalists. Though I will say over the last few years, we've spent a lot of time focused on what we called applied AI. So that's AI in the product, trying to solve solutions, drones and robotics. And for the 7th fund, it's become very clear to us from a national security perspective and from a secular growth perspective that there's going to be huge disruption in rejuvenating the energy sectors and the manufacturing sector in the US. And so the 7th fund is focused on that. There will be a lot of investment opportunities across real estate, debt, private equity in these sectors. We think there's a venture slice And we think the demand for energy can't be satiated. It's generally grown 50 basis points a year. Last year it grew 4%, and it's eroding the cushion. We have to find ways to be more efficient with the energy, and we think applying AI there can be really helpful. Also, battery technology, small nuclear technology materials. And on the manufacturing side, we're not going to replicate the supply chain that was overseas. We're going to build a new supply chain here using new technologies. So technologies like 3D printing that have been a bit of a damp squid to date, I think will come into their fore.
Yeah.
A lot of things around logistics, applying
And by the way,
AI,
I think a lot of
robotics.
a lot of people don't appreciate
factories.
that. Like when you have an AI startup, like I was in the office of a startup in San Jose, like must have been more than 10 years ago. And they were making a little robot to help elderly people. And they had like just shelves of AI of 3D printers making stuff. And the reason they were doing it is that absent their 3D printers, they would have to like call up Foxconn or somebody or Flextronics and say, make me a bulb like this with a finger like that. And they have to wait days or weeks for that to come and do a run. The 3D printing,
Expensive.
but just the time,
Yeah.
the time to, if I want to make a change in software, I can just do it. I can send out a wireless service book, fix that problem. Hardware, you drop something in a river, the turbine, and it's a punishing, horrible mistake, and hardware is hard. That 3D printing really collapses the cycle time to lean startup, iterate, make a change, measure.
But also, you then combine 3D printing with AI solutions to the physical problem you're trying to solve, and you end up with innovative designs that would not have necessarily been built by a human with a slide rule, but you know what I mean.
Yeah.
And
With the
you have
limitations.
something that looks quirky that solves the problem and addresses it in ways that you wouldn't have thought of before. And the iterative process, as you talk about, with 3D printing combined with AI design work, can lead to whole new innovations. So we think manufacturing is sexy. We think energy is sexy. We think there's strong secular drivers, irrespective of administration, though this administration is leaning heavily into this. And we think it's a national security need to have certain of our goods, drugs and the like manufactured in this country, and to have abundant, cheap electricity. And we think there will be a Cambrian explosion of startups trying to solve this problem. I use this analogy. NASA is full, literally, of rocket scientists. And yet it took a technologist to come in with a different mindset. SpaceX, which now has 90% going to 95% of payload to space worldwide, to come in with a different way to drop costs 1, 2, 3 orders of magnitude. In the same way, energy is full of very bright people, but people will come at this in a different way, particularly if the regulatory environments can change a little, and help us with efficiency. The next 3-4 years, it has to be efficiency driven. About a quarter of electricity that's generated doesn't get used, and it's not just transmission. There's inefficiencies in the whole process. And the ways you can tweak that up will really help. There'll be manufacturing techniques around batteries. And batteries are essential because they can help us time slice, wind and solar and itinerant energy production to make it more stable, because we tend to consume, across different patterns, whether the sun is shining today or the
Well, even in
blowing.
places like Texas, it's like a bid-ask cost of energy. So if you can buy your energy from the grid between 1 a.m. and 4 a.m. and store it in a battery, and then draw off of your cheap stuff, while everybody else is paying with no battery for the peak load pricing, you're just like Uber surge pricing every day is getting out of Times Square after the ball dropped. That's going to be an expensive taxi. How about buy it when nobody's in Times Square and then use it when you need it? there's a lot there. I think the arbitrage opportunity of labor, I mean, like China becoming the factory of the world, if you've been to China lately, you can spend a lot of money just moving around. The arbitrage opportunity of labor, of low-cost labor being in China, has been going to India and Pakistan and Vietnam for a long time. But when you see the automation of factories in China, in a Tesla, factory, it makes you think that the United States can be the factory again. But it's more of like a war-driven necessity. We need that energy, and we need to do it for various industries, if not everything.
And then, absolutely. I use this analogy. 30 years ago, labor was 60% of the cost, and it was 1/20 of the price. So huge arbitrage. You had to pick up some shipping costs. It took a little longer, but you moved your factories overseas. Today, labor isn't 60%, it's 20%. And the arbitrage cost isn't 1/20th. In China, it's like half, but in other countries, maybe it's 1/10. But you've still got the shipping costs, and you have the national security issue. And you put all that together, the arbitrage doesn't make so much sense today. And tariffs at the margin, obviously. But there was so much momentum for doing this for 2-3 decades that people kept doing it, even though the economics didn't make sense. And now people are really woken up to it.
Yeah.
And I think if there's any positive of a global pandemic, it's that we realized how fragile our supply chains were.
Yeah.
And that's changing. It's going to take 10-20 years to fully do it, but it's going to change. And again, the factories that we bring back here will not be a carbon copy of what's overseas. It'll be next generation.
Yeah. Yeah. One of my early jobs was for a company called Duraline. It was manufacturing HDPE duct that fiber optic cables went into. And if the guys needed to deliver just 1 kilometer, one exit further down the New Jersey Turnpike, it was that much more expensive. And the result is that you had to start building factories in the places where you had big orders, because one little bit of shipping had a massive impact on that. If you can get to more automation in factories, forgetting the national security mandate that was obvious coming out of COVID and the current administration, Chinese won't be able to compete with a duct factory that's automated, that is, in Southern California, compared to shipping it, around the world.
And to tie this together, we started this conversation saying you can do a lot more with fewer people if you sprinkle some AI dust on that business.
Right. So AI native.
And now what we're saying is there'll be new manufacturing startups to address these problems, but the new startups themselves are going to be run much more efficiently themselves. They're going to be using new tool sets. And so those organizations, each of those elements of the supply chain are just going to look different. And I think it's really a fascinating time to put capital to work, where you've got all of these technologies coming together. When I started angel investing in December 99 at Goldman. And then when I left Goldman in 08, I said, let me take this professional. So I've been, when I started, I kind of said, we're in a long boom. It's going to take 20 years. Well, 25 years later, I feel like we're in a long boom and there's another 20 years.
Yeah.
So, I can't think of a better time where you have smart people being freed up out of companies who are going to start companies addressing real problems that are going to help the economy. I think it's a fascinating time to put capital to work. I think the nice thing about venture capitalism is it's capitalism. It's about efficient allocation of capital. And I think this is a great time. It's a great part of a cycle to be doing this right now.
Well, John, can't wait to see you in person next week in New York. And we'll have to publish this quickly so people can see it and meet John in person. John, looking forward to being part of this FF venture with you as an LP and co-investing. So bye for now. Thanks so much.
Thank you. Bye-bye.
See you, John.